Sole proprietorship versus incorporating. Which is better for you? Spoiler alert, it depends on whether you need to take home all the money now or if you're able to defer some for a later date. From a numbers perspective, being a sole prop versus incorporating has different tax advantages since less taxes paid in equals more cash flow for you. We'll specifically talk about runway and cash flow planning in another video since each situation is unique. Let's start by looking at high level advantages of incorporating. This article I'm referencing from is on owner.co. I'm not affiliated with them, but when I was doing research over the last year on whether I wanted to incorporate, I came across them and they had some really great resources and articles for small business owners. So definitely check them out if you're curious to learn more. So first advantage of incorporating is limiting your liability. While it won't protect you and absolve you with full immunity, it does create an arm's length if something does go wrong with your business. And so being able to create a separate entity will definitely help you absolve some of that legal liability. The second advantage is separating your personal and business finances. As a practicing CPA, I can't tell you how awesome this is as being able to have your books separated and see what's a personal expense and what is a business expense is very important, especially if you plan to raise money down the road or if you're just needing to show your books to have a higher line of credit or looking to sell your business as one, it's good practice to do so anyways, and two, external stakeholders are going to demand it as they want to make sure that what you said you're doing is as accurate as possible as what the books show. The next advantage is tax related. We'll go into specific numbers and some calculations in a bit, but high level, it works on both sides. As a sole prop, especially in Canada, you're able to, if you take all the income in as a sole proprietor, you're able to increase your contribution to your RRSPs. On the flip side, if you are taking the income as a corporation and then paying yourself through dividends, you're able to use a lower tax rate as a corporation. And if you plan to leave some money in, then you can take advantage of that lower rate over the years as opposed to the rate that you'd be taxed on personally. And we'll look at that a little bit in the spreadsheet I've created. Next advantage is that it's just easier to raise money with a separate entity. And down the road, if you ever want to sell just a piece of your business to raise equity, get shareholders into the company and just raise money that way, it's easier if you already have an incorporation set up and am already maintaining it than to having to do it at that moment of time. As well, taking a loan from either the bank or getting government funding is easier if you have a corporation than if you're a sole proprietor, just because of the liabilities and just having that proof of that you're running a business and that you've been paying payroll and that you're legitimate over X number of years will really add to that kind of validation that your business is in good standing. And the last piece is establishing professional credibility. This could also go both ways. If you're offering professional services and your name is really important to kind of your business model, then maybe it still makes sense to be a sole proprietor if you're offering like consulting services or consultations or versus if you plan to scale, you're adding employees who represent you, but also they're doing consulting, but under your brand, maybe it makes sense to incorporate. And it really depends how fast you want to grow and what your ambitions are down the road, and um, keeping that in mind, that will definitely help you decide whether you want to incorporate now or later or not at all. Going back to looking at the tax situation, um, it's important to know, one, especially in terms of just understanding structure and how you get taxed, whether you're in Canada or internationally. As a sole proprietor, when you take home income, you get taxed on it on your personal rate. Whereas if you set up a incorporation, you get taxed in the corporation's rate, which in Canada, it's a lot lower than the personal rate. In fact, in BC and Canada, it's at 11%, whereas the average personal tax rate is way higher than that. And so, what we're going to use is a combination of a calculator that I built and using a tool like Wealthsimple's personal tax calculation. This is based on 2022, but the numbers are going to be roughly similar year over year. So we're going to use this. But it's really giving you a numerical understanding of why incorporating makes sense to you in this situation or not. So in this situation, we're assuming you make 100K net. So this is after all your business expenses. You're looking to bring home 100K. And so as a sole proprietor, you get taxed 100K. So using this Wealthsimple calculator, if we say you make 100K, nothing else, you don't get paid dividends, you don't have other employment income, you're not contributing to your RRSP, your total tax is around 27K worth of taxes. That's like 20 from just being taxed and 7K of the Canadian pension plan premium that you have to remit if you're going the sole prop route. So that gives you an average tax rate of around 27%. It might be different in terms of the CPP or EI or other social programs you have to pay into as a sole prop in other countries, but it is what this is in Canada. And so you're effectively taking home around 72.8, so 73K as a sole prop in this year. And we're looking at this over, let's say, for this scenario, 3 years. So if you were to net 100K for your corporation, you get taxed at the 11% rate. If you're a business that makes less than 500K per year, you get the small business tax rate, which is way lower than the corporate tax rate. If you're making over 500K, this is a different situation, and we can explore that later. But let's just say you're making this amount, so you get taxed at this rate. And so to get equivalent to your equivalent effective take home as a sole proprietor, let's say you dividend yourself out 85K from the 100K that you earned. So that means your dividend tax, which is calculated with this really complicated calculator that I've built and modeled out. In this case, this year you would have to remit 12K personally off the 85K that you're paying yourself out personally. And so let's just assume year over year the income doesn't change in this scenario. So as a sole prop, you take home this much. So year over year, given the rates stay relatively the same, you're paying close to 81K over 3 years. Whereas if you dividend yourself out the same amount, and then last year, let's say you pay everything out, you just said, hey, I'm just going to dissolve everything. I'm just going to, just to make it apples and apples, this is how much we want to have left in the bank at the end of the day in 3 years, you're actually only, even at a higher tax rate, because you're going to have to pay more off because you're taking more dividends to yourself. Even at a higher tax rate, you pay 10K less over the 3 years than if you were being taxed as a sole proprietor. However, there's other things to think about. So over the next 3 years, you're probably going to have to incur bookkeeping costs and the cost to maintain your business registration as an incorporation. And so maybe over 3 years, you pay 2 to 3K a year to maintain all that. Obviously, depending on the complexity of your business, those costs could be way lower, especially if you did it yourself. And maybe it comes to 1K a year just to maintain it. But those are things to keep in mind. It's like, oh, you have a 10K difference, but there's other incremental costs that add up. But in this situation, I mean, if you didn't withdraw everything all at once, you kept more money into the business. Let's just say you just only paid yourself out 85K a year. You got taxed at this rate, so you're looking more at a 15K difference. Sorry, a 12K difference here, and over time that might add up if we extend this timeline down the road. And so those are things to keep in mind as a sole proprietor. Again, in Canada, let's say you're able to contribute to your RSPs. Let's say at least $15,000 a year, right? And also in Canada, there's this new tax-free first home savings account, which pretty much acts as a RSP, as basically the investment you make into it can be deductible in computing income for tax purposes, which is effectively what our RSP does, because it offsets the amount of income that's recognizable for your personal tax and effectively lowers it. So, for example, if we didn't have a RSP deduction, your taxes are at 27K, but if you could contribute to your RSP, it actually lowers it by 5K in this example, lowering your average tax rate. So let's say we lowered this to, let's say 11217, 237 237. Your CPP stays the same, right? Then if you're able to contribute to your RSP every year, that's great. That means your effective tax rate is lower. This is 22.61 compared to your corporate tax plus your dividend rate, which is a result of you end up paying more being incorporated down the line in this scenario. But again, if you don't want to contribute to RSPs, you want to keep more money in the business. Let's say your take home was you only wanted to take away, let's say 40K. Let's say that's what you need to live off of, right? So 40K, and your dividends is 40K. Your average tax rates are that. I have a broken formula. So this should be in 30. That's why I wanted to build an app for this, but right now we have a spreadsheet, so there we go. So let's say you get taxed at for that. Right, your effective tax rate is only 10.43. There you go. So what we're looking at is if your take home is only 40K, let's say that's all you need to draw from your incorporation to live for the year, you can bank the rest away, so you'll only be taxed at this rate, meaning you'll only pay this much in taxes, whereas you're forced to pay this much in taxes even if you contribute to your RSPs as a sole prop. So again, each situation is different, which is why definitely have a consultation with an accountant, or happy to have a chat with you about based off of your situation. But these are all the different levers and things you want to think about when it comes to tax implications within incorporating. And so a couple of tools that I found very useful: this Wealthsimple calculator again. They've been great at calculating kind of my personal tax situation. There's also taxtips.ca to really understand the rates that you get taxed at. But again, over time, it's very incremental, very immaterial in terms of how much changes there are. And so just for this scenario, I didn't really change it all that much. But yeah, so given that, those are things you should think about when whether to incorporate or not. And if this was useful to you, hit subscribe and join the journey. Otherwise, leave a comment below if there's a certain topic you want to explore. And wishing you guys a great day. Take care.